What is investment funding? Investment financing applies to projects of a long-term nature. Unlike operational financing, which deals with day-to-day business expenses and costs, investment financing is used for development purposes, such as purchasing new equipment, building new facilities, or developing new products or services. Investment financing can be carried out in a variety of ways, including issuing stocks or bonds, obtaining an investment loan or credit from banks or financial institutions, or obtaining financing from venture capital funds. One of the key aspects of investment financing is the assessment of risk and the chance of return on investment. Investors usually look for projects with high return potential, but at the same time pay attention to the risks associated with the investment. For this reason, entrepreneurs and companies try to prepare solid business plans and development strategies to convince investors to finance their projects. Raising investment financing by issuing shares or bonds. This is a popular method of raising capital for the development of a business or the implementation of a specific project. It is worth mentioning, although, of course, such a method of financing does not apply to budding entrepreneurs. Both instruments have their advantages and disadvantages, so companies must carefully consider which one will be best for them. Issuing shares means selling part of the company's shares on the capital market. Shares, on the other hand, are securities that give their holders the right to vote at general meetings and to share in the company's profits in the form of dividends. Issuing shares is usually a more complicated and costly process than issuing bonds, but can yield higher returns. Companies must carefully analyze their financial situation, development plans and goals to determine which instrument will work best for them. In the case of a stock issue, it is necessary to determine the company's market value and set a stock issue price, which requires financial and marketing analysis. When issuing bonds, it is important to determine the size of the issue, the interest rate and the repayment term. Obtaining an investment loan or credit from banks or financial institutions. This is another popular method of raising capital for the development of a business or the implementation of a specific project. An investment loan can be a favorable solution when a company needs a large amount of money to implement development plans or to cover investment costs, but is unwilling or unable to use other methods of financing, such as issuing shares or bonds. Banks and financial institutions offer different types of investment loans and credits, depending on the needs and capabilities of the enterprise. Loans can be short-term, up to 1 year, medium-term, 1 to 5 years, or long-term, more than 5 years. Investment loans usually have a longer repayment period and are designed to finance capital investments, such as the purchase of machinery, construction of a factory, or development of infrastructure. Companies wishing to obtain an investment loan or credit must first of all prove to the bank or financial institution that they can repay the loan on time. It is important, therefore, for a company to provide the bank with a solid business plan that accurately states its goals and development plans, as well as to conduct a risk analysis and identify sources of income that will allow regular repayment of the loan or credit. Obtaining financing from venture capital funds. This method of financing is particularly suitable for startups and companies that plan to grow and expand in the market. Venture capital, VC, is high-risk investment associated with financing young ventures that have high growth potential and innovative solutions. Venture capital funds usually invest in early-stage companies that have not yet reached full profitability. Typically, VC funding is for product or service development, new technology implementation, market development or expansion into new markets. In exchange for funding, VC funds usually expect a significant stake in the company and influence over strategic decision-making. VC investors are usually actively involved in the management of the company and monitor the progress of business plans. Obtaining funding from VC funds requires a company to have a high-quality business project, based on innovative solutions, with high potential for growth and scalability. VC funds carefully analyze a company and its market and financial prospects before deciding to invest. The cost of VC funding is usually high, but in return the enterprise receives not only funds, but also the knowledge and experience of VC investors. VC funds can help the enterprise manage, build relationships with customers and business partners, and raise further rounds of funding. Risk assessment of investment financing. Financing risk analysis involves the preparation of relevant documents and presentations to convince investors to invest in a project or venture. First, the entrepreneur should prepare a business plan outlining his business objectives, business strategy, product or service description, market analysis, competition, marketing plan, finances, and other key information about the project or venture. Next, the entrepreneur must conduct a risk analysis of the investment, including identification of potential risks and ways to minimize them. In this part of the analysis, the entrepreneur should pay attention to such factors as market risk, financial risk, operational risk, technological risk, political risk, and others. After preparing the business plan and risk analysis, the entrepreneur should prepare an investment presentation, which will include the most important information about the project or venture, as well as information about the expected return on investment for potential investors. During the investment presentation, the entrepreneur must skillfully present his business vision, the advantages of his product or service, the market and financial potential of the project or venture, and how to minimize risks. The presentation should be clear, concise, and convincing in order to attract the attention of potential investors and convince them to invest in the project or venture.